Well, hello everybody, it's LA, and I want to take a look at the breakout trade entry, how you do it, why you don't do it. You know, if we think about trades, there's really just two types. There's breakouts and there's retraces. And as most of you know, I'm more in favor of retraces most of the time, but there are cases where breakouts make sense. And this short video is going to look at both the good and the bad associated with the breakout trades. So let's take a look at what is the advantages and say disadvantages associated with breakout trades. We'll start with well, actually before we do that, let me back up and do something else. What is a breakout? A breakout is where price breaks over some existing swing point. So if I'm looking at this particular time frame with gold, for example, you know, there's a swing point high here, and when it breaks over this at this particular point, right, that's a breakout. It's got to push up, it's going over the highs, that portends a breakout. Now what's the risk associated with a breakout? And the risk is, well, that it comes right back. Sometimes it does, sometimes it doesn't. And what we want to look at is what are those cases where it does break out and just keep going, and what are the cases where it's probably going to come back, because naturally you want to buy this breakout if it's going to keep going, and you don't want to buy this breakout if it's going to come right back. So let's talk about the advantages and disadvantages of a breakout trade. If I think about the primary disadvantages, there's really two. One is your trade risk profile is usually higher than it would be if you are trading retraces. And what I mean by this, and when we're looking at this particular, matter of fact, let's look at this high right here. So here's a good example of it. You have a high here and a high there. This breakout, right? What's the odds that this thing just keeps going? Well, there's differing odds depending on what the situation is, but as you can see, this particular breakout, if we look at the exact price points here, this high was 115.81. This was the breakout. Next trade closes as low, or trades as low as 116.17. The next one's 115.85. So you can see it almost comes back. 115.81 versus 115.85. So it almost comes back and touches where it broke out. So in this particular case, it didn't just break out and keep going like we saw it do up here. Now if you buy this breakout, where are you going to buy the breakout? Well, when it first starts to break out, and let's put some lines up here so you can see it. When it first starts to break out, right, you really can't buy it as soon as it breaks out. As you see here, it failed. You have to give it a little time. So if you're going to buy that breakout, you're probably going to get it somewhere up here. And then the next day, the next 2 days, you can see as it trades back down, your entry point, right, the price of entry is up here somewhere, right? And it trades back down to here, and now you're going to get concerned about whether you need to stop out or not as a result of this thing trading back down. And so your entry point, the cost of entry, is going to be higher. And so the main disadvantage you have is if you're buying the retrace, you're going to buy lower. If you're buying the breakout, you're going to buy higher. If the breakout fails, you're going to have a higher entry point, therefore you have more risk than if you buy the retrace. And so when I say, you know, the breakout has higher risk, you know, that's what I'm talking about. Your risk profile is higher. The other thing is that the probability of an immediate retest and an attempt to regenerate is very high. And I want to show you some stats associated with, and here's some stats that I had in my third book. The number of bars prior to the first retest and regenerate sequence, right? And this is a stat showing that. So once again, let me pull up the chart and let me show you what I'm talking about with respect to this. And let me grab the chart here, and there we go. So when this breaks out, what is the probability? And here's another good example of it. We can take another example. Here's a swing point high here. Here's the breakout, right? You get over it and you close over it. That's your breakout. What's the probability that this is going to come back and do a retest, regenerate? In other words, come back and test this whole thing, right, all the way potentially to the low of that bar. What's the probability that it will, in fact, come back after it's broken out? What is that probability? Well, it's very high. And that's why when I say that you want to look at retest, regenerates, in other words, retraces, it's a higher probability that they will come back. Depending on the type of trade, confirmed bullish, suspect bullish, and then bearish and suspect bearish, look at the probabilities associated with them. Anywhere from about 68 to about 83% will immediately come back within 5 bars, right? And then the majority will come back within 10 bars. The vast majority will all come back within 10 bars. When you see a stat like that, what does that tell you? That tells you most of the time that breakout, just like this one here, is going to fail. It fell in the sense that it's not going to just keep going up, it's going to actually come back. And so when you're looking at a breakout and you're asking yourself, should you buy the breakout? Well, you know that the probabilities in most cases are that it's immediately going to come back within 5 bars. So why buy it? So that is the main disadvantages. If you flip to the other side and say, okay, what's the primary advantage? Well, that's that if it breaks out and it's a strong trade, you may not get a retrace. In other words, it may take a while, and it could take quite a while. If we go back and look at that stat that we were just looking at, you know, the rest of these probabilities, you know, what is that, 68, for example, here on a confirmed bullish. So only 68% are going to come back. That means 32 will just keep going. And if we go back to this chart we were just looking at, you can see in this last breakout, that's exactly what happens. This thing is broken out. It's over 6 bars yet, still hasn't came back. And so the breakout is here, and this has yet to come back. Will it come back at some point? Probably, but this thing may, right, set up a little ABCD structure and keep going. May not come back for a long time. And if you wait to try to jump this trade for a retrace, you may not get the retrace. This may just keep working higher and higher, and you never get in. That's the main advantage of buying that breakout trade. And so, you know, when I'm talking about the breakouts and I'm talking about, you know, when do you want to do it, when do you not want to do it, that's when you want to do it. Finally, if we end up saying, okay, we do want to buy a breakout trade, or we want to short sell a breakout trade, then what are we looking for to tell us that that probability associated with that trade is going to reward us? In other words, we're not going to see a retrace. We're not going to see, if it's a bullish one, we're not going to see, you know, this case here. In other words, it goes up and then comes right back. Or if it's a breakout to the downside, we're not going to see it go down and come right back. What tells us this is not the case we're going to see, but instead we're going to see it just go up, or we're going to see it just go down? And if we ask that question, you know, you want two things. You want the market to generally be strong. And when I say the market, I'm talking about the general market or the sector, either one, right? You want them to be generally strong or generally weak. And let me take it back, really strong or really weak, not generally. And then you want multiple swing point breakouts occurring on multiple time frames. So let me take just a few minutes and show you what that looks like. And we'll take the bullish case first, since I have gold sitting here. You know, what was it in this particular trade that could have told you that gold itself was going to just keep going and not come back? You know, what was it here? Well, part of it is this thing had consolidated for a while and had shown attempts to break out, get pulled back, right? And then eventually rise. And like we just saw here, it never did do the retest regen here, missed it by 4 cents. And then when it broke this one, it never even came close. It gapped up and just kept going. So what would have told us on that particular trade that we probably wanted to buy that breakout, right? Because think about your risk here. If you buy it here, your risk is all the way back down to here somewhere, right? That's a fairly large risk you're taking. And so what would have told us, and what told us, of course, is that this thing was breaking out on multiple time frames. So let's take this price here. That price is 118.47. Let's pull the weekly chart over. So 118.47 on the weekly. This particular high is 120. 118 is right back here. That's the 118.47. So what was happening is that this was breaking out, but it wasn't a breakout on a swing point high. That didn't happen until you got to here. But what was that price point? Well, that price point was 120.50. If we pull this back aside, 120.50 is where? It's right here on that breakout bar. That gap up breakout bar, the low on that particular gap bar is what? 120.34. It's getting over the swing point high on the weekly time frame. So you're breaking here on the weekly and you're breaking on the daily at the same time. Multiple swing points, multiple time frames. In this particular case, it's the sector as well, since this is the sector. That's the sort of thing, and you saw this on many of the gold stocks that I've been talking about in the, at the time that I happen to be recording this, that this was a legitimate breakout and actually had the staying power. That's a breakout to the upside. Let's look at the downside. And to look at the downside, here's XLE. We know that, again, at the time that I'm doing this show, the downside or the weakness in the oil sector has been extreme. We're looking at the XLE here, which is the large cap oil stocks. There's a swing point low here, a swing point low here, and what happens? It breaks them both, and it breaks them both on one fatal swoop, right? This bar gaps down underneath them both, multiple swing points. How about multiple time frames? Do we have that as well? And in fact, we do. If we look at these lows, this lowest low is 83.53. Let's bring the weekly over. 83.53 on the weekly. Let me clean this up so we can see it again. In this particular case, 83.53 is going to be this low. It's actually lower. It's 81.78. So 81.78, this bar, as we break down, breaks through this low, and the time frame here again is November 24th, breaks through this low, November 24th. We're here on the 28th on this one. Here's the 24th is this week. That's the 28th. That's the breakdown. Breaks down multiple swing points, multiple time frames. That tells you that this thing more than likely is not going to make it back up to here, and it's certainly not going to make it back to this gap area. Gets a little bounce, right? That's the sell, the little bounce. If you bought the gap, you're still going to be okay. You just have to worry, but you got a little bounce you could have bought, or excuse me, sold short, and then you get the big move. That's the sort of and then the reason you get a bounce here, if you think about it, is you already had a huge move. So it's natural to think you get some sort of a bounce, but as you can see, it doesn't do much, and then they come in and sell it hard all the way down. Multiple swing points, multiple time frames, and before I end, just think about what's happening. Anyone, and I'm going to pull the weekly back over in this case, anyone that has bought from way back here, way yonder, we're talking about almost a year, anyone that's bought over the last year is in a losing position. That's the sort of dynamic behavior that can get a large, strong move down. And when this thing breaks, you can see they don't let them out. Those losers now, this becomes serious resistance on the way back up, because anybody that bought is underwater, and they're going to stay underwater for a while. and they're either going to have to hang on for a very long time, or they're going to have to eventually just take their losses. If you go back to the other side and look at the gold, and if we look at it here on the weekly, you've kind of got the same situation. It's not nearly as strong as that oil breakdown, because usually to the downside is a lot stronger than the upside. But if you take and look at this, right, that breakout, that's the first time that you've had this move back up. Now notice we're not breaking the big swing points at the highs. We're not breaking up here yet. We're just breaking the lowest high. So that says, yeah, you can get a push, but you're probably going to come back and do some sort of retesting back into this zone in here. And then you might get another large setup to the upside. And that is what? That's the retrace trade to trade higher. A little different situation. If you're breaking these highs, you might just get one of those big, fast moves up, because anybody that shorted this thing is now in a losing position. It's the same sort of ideal, just in reverse. It's just that on the downside, things go a lot faster and farther than they do on the upside. It takes, it's kind of a grind on the way up, takes a long time comparatively to the way down. Multiple swing points, multiple time frames. That's what you're really looking for, folks. You're looking for the sector of the general market to be really strong or weak, and you're looking for multiple swing points if you're going to try to trade breakout trades. Hope that helps, and hope that is informative.